Hello, everyone, and welcome to today's session talking about Schedule E. And I'm really excited because we get to kick off a new series. If you've been with us before, you know that we've done these deep dives into separate schedules or forms. We did a Schedule C series that spanned over maybe 2.5 months. We did a Schedule A series, also almost 2 months, because it goes into different types of categories on that schedule. And yes, our tax software can help us populate those numbers, but it is our expertise that comes into play on understanding how those schedules get populated by our softwares and understanding if it's doing it correctly. With that, thank you so much for joining us today. Happy Wednesday to all of you that have joined us. Today is a Schedule E series kicking off, and I will share my screen to get us started. We have a lot of information because we do have this session available for CE credits. So with that, we can get us started. Lots of learning today, but that's okay. The stuff that I'm going to talk about today, it is a very high overview because, again, if you've been with us in our prior series that we dive into these schedules, you know that our first session is to kick it off to get us grounded on the foundation of what this schedule is highly about. And then we dive into each section by section throughout the 2 months that we're going to be together on these sessions. With that, I would love to introduce myself for those of you that are joining us today and we haven't met. My name is Nadia Rodriguez. I am a CPA and I am in the city of Dallas, Texas. We are going through a huge heat wave here in Texas. For those of you that join us in those type of states down south, you understand what we're going through, the suffering that we're going through. But thank goodness for AC. So I've been in practice for over 15 years where I had my tax practice more part-time because what I did full-time for several years was work at the corporate offices of Intuit. What I did with Intuit, which was a very specialized niche for CPAs, is that if you understand the tax software and you understand the tax result for a taxpayer, then all they have to do is teach you how to write code. And so I went through a very intense 8-week program on how to write code so that we can do our tax software. And that's what I did for about 7 years with Thomson Reuters, and then another 6 to 7 years with Intuit. I sat down behind the screen and wrote computer code all day because I understand as a CPA tax professional, the result of a tax return. And so that's where my expertise came from. But at the same time, I was still doing my own tax firm on the evenings and on the weekends. So finally, about a year ago is when I decided to jump ship. And I went on and did full time of my now tax practice, running it full time. But also, I founded the Nadia CPA Inner Circle, which is a tax community for all of us tax professionals coming together, sharing tips and tricks, and learning together. Because once you realize that you're out there being a solo practitioner, and if you're not working in a tax firm, things can get a little bit hard because there's not really somebody that you can run over and say, let me run this idea by you. And that's what the community is built for. We champion respect and we champion any type of questions that can come your way because we are all at our different paths in our learning journey. So no question is ever too simple, or if it's too complicated and we don't have experience, then let's learn about it together. I also founded the Tax Training Academy. That is where you can find the master classes, the more deep dive courses, which right now we are in our spring cohort for our master class in S corporations. It's a 10-week program. So shout out to those students that are in with me in this spring cohort and my alumni that joined me last year for the fall, because we understand how intense S corporations can be, but really understanding the foundations and building it more into how we can prepare and advise our clients for S corporations. With that, thank you for connecting with me today. It would be great if we can continue our conversation and get to know each other within the Circle community. So today's session is an hour long. It's about 50 minutes that you can stay with us, and that's how you can complete your CE requirement. We can issue your CE credit only if you stayed with us for 50 minutes, and if you've answered our 3 polling questions. You'll find those throughout the slides, and I will make sure to announce it and make maybe give you about a minute or so to give you enough time to answer that polling question. Now, based on our experience with prior sessions that we've given, if the polling question is coming up and you're not seeing the window anywhere where you can select the answer, or it's not working, technical issues on your side or on our side, make sure that in the chat that you are letting us know a response, because all we need to do is take your attendance. Does it matter if it's the correct or incorrect response, as long as you are participating here with us? Now, if you do have questions related to the content, I am going to leave some time at the end of the session that you can stay and hang out with us to answer some of your questions. And go ahead and use the chat feature. I go through the chat to see what questions have been posted. But at the end, you can also just raise your hand and take yourself off of mute and ask your question, and let's figure it out together. Now, before we do get into our content, I do want to let you know about our upcoming events within the community that are happening. Schedule E series, like I said, today was just laying the foundation for you. We're going to really deep dive into each of these sections later on for Schedule E, talking about passive losses, talking about long-term rentals versus short-term rentals. And you've probably heard all over TikTok about how you can write off your depreciation for a cost segregation study against your W-2. Either you heard it or your client sent it to you, but we are going to really master that area, because it's not as easy as they make it seem on social media. We are going to deep dive into each of those sections. Today, laying the foundation. Later is when we're going to actually go line by line on Schedule E and maybe take some little diversions of passive losses, right? We need to understand what passive activity means and how that gets reported and made into Schedule E. Also, you can see for July, we are talking about more about technical sides, and that's what the community is about. Not only are we bringing you tax education, but also areas that we see when you're running your firm, what could really help you advance. One of those is if you have still an email that you're providing to your clients as @gmail.com, there's a better way that we can show that as a domain. For example, at Susie'sTaxOffice.com. That, I think, positions us more out in the field as more that professional tax expert that we are. So we are going to have a session on the 23rd. It's general access. So those of you that joined us today that are not part of the Pro Circle membership, you can also join us for that July 23rd session on showing you and walking you through the steps on how easy it is to drop that gmail.com email address. Of course, on July 30th, we have AI support session for Pro members only. AI is all around us, right? There's no escape. And I think I've talked about this with the class before, is that AI will not replace us as tax professionals. Instead, what will replace us as tax professionals are the tax professionals that are using AI. So let's really start mastering AI and getting familiar with it and not be afraid of it. And that's what we do with our support sessions. We walk you through all of these items about AI. Of course, August 6th, we're going to talk about how to find your business. Your clients can find you easy and find you more and on Google websites. And of course, August 20th, we're building your website with AI. We're helping you do that and walking you through that for the Pro members. And on August 23rd, we're going to have a vendor come and talk to us. They're called the Rise Collective, which fits perfectly with our Schedule E series, because this company is going to talk about on how they can help our clients with finding that short-term rental, that Airbnb vacation rental, and how both of us, you the tax pro and this company that you would partner with, how you can both help your client on meeting those material participation tests. Now, if you have no idea what I'm talking about, material participation, that's okay, because we're going to go over that during our Schedule E series over the next 2 months. Now, with that, if you are interested in joining our Pro membership, you can scan this code and join us for $1 for your first month. Come and see the value that you can get out of it. Ask questions, ask others that are here in the room with us that are part of the Pro Circle membership on what the value that we bring to them. Honestly, like I said, this was my passion project when I started about a year ago, and I'm so grateful that I get to do what I love. Now, with that, are we ready for class? Here we are with Schedule E on the 1040. First, let's bring it back to what do we know about the general rule for tax purposes? We know that taxpayers, we are taxed on our general worldwide income, even to the point that if you find money on the floor, technically, according to the tax law, you're supposed to report it as income. And so when we talk about rental income, you're renting something, and we're going to go into what you're renting for Schedule E, you have to report that income. Can you take expenses against it? We're going to talk about that. So, how does that fit on your 1040? If you're looking at a 1040 on page 1, we know at the very top, of course, it has the taxpayer information and their address. But towards maybe the after that, we see that you start off with what? Wages, right? W-2 wages. And then you have a lot of lines that you have to add on to those wages. Every type of scenario that we can think of related to income, the IRS will have it covered. And we know that one of those lines is an accumulation of all of the income that you have reported on Schedule 1. Now we know that that flows over to line 8 of your 1040. You can see here additional income from Schedule 1, line 10. Now, have you looked at Schedule 1? We know that it's 2 pages, and it's going to list a bunch of random income items that if the IRS didn't list it for you, don't worry because they have a line that says other income. So yes, general law here is that all income is taxable. Now, if we specifically look at Schedule 1 for our 1040, you can notice here Part 1, line 5, real estate, royalties, partnerships, S corporations, trusts, etc. From where? From Schedule E. And so just the net amount is what's going to flow to 1040, Schedule 1, and then this whole accumulation of Schedule 1, we saw that makes it to the 1040. So let's talk about Schedule E. We know that here's where you're going to report all of your income or loss from rental real estate, from royalties, partnerships, S corporations, because they're going to issue you a Schedule K1 to the taxpayer. The estates and trusts, they're also going to issue a Schedule K1. And then, of course, these REMICs, which are not very common, residual interest in real estate mortgage investment conduit. What is that? We're going to go through that. But just know that this is what's covered under Schedule E. Now, when we look at page 1 of Schedule E, part 1, that's all that encompasses page 1. We're going to learn later, page 2 has other parts that are covered, but this just gives you the majority of part 1 of Schedule E. What we commonly know is where you report a rental property's income and expenses. Yes, page 2 is going to report other type of income, but for now, let's just focus on part 1, which is page 1. Because what does this do? It's going to report the income or the loss that comes directly from any kind of real estate that the taxpayer owns. And watch for the key word, directly owned. So think about this rental real estate, this property. Who owns that property? Is the deed titled to that individual taxpayer? Or is it titled to a business like an S corporation or a corporation? We need to really pay attention and ask the question and confirm, even though you were assuming, if this taxpayer comes to us, they don't have any other type of business, let's just confirm that the deed is titled to their own personal name. Or if they're married, is it husband and wife? We need to start asking more of these questions. And we're going to learn during today's session why the ownership matters. Of course, on part 1, you also can report the income or loss from the rental of not only residential properties, right? The single family homes, the duplexes, the multifamily, the apartment buildings, even commercial buildings. So any type of these rentals can be reported on Schedule E. We also produce on part 1 any type of royalty income, and we're going to go over what that means. And of course, multiple rental or royalties owned by the taxpayer. We see that the columns, if you can notice towards the middle, A, B, and C. Here's where you can list if you have 3 separate properties that are producing rental real estate income or royalty income. Now, if you have more than 3 properties, we know that the instructions say we'll attach more of page 1 of Schedule E. Just keep on attaching them because we want you to list each property by property. You're not going to bring them all together and list them together unless we have aggregated that in an entity. But for Schedule E individual income tax purposes, we are listing these separately. So let's talk more about rental real estate. We know that rental real estate is single family homes, right? Whatever is a structure attached permanently to land is what the IRS considers as rental real estate for purposes of Schedule E. We see here that they have also vacation and short-term rentals. Think about those vacation homes. If you have taxpayers that have like a lake house or another property maybe out close to the beach that they use during the summers or when they please, it's their vacation home. Well, are they renting that vacation home to somebody? Then that's when we have to start asking the question on the number of days that they're making it available to be rented by somebody else. Of course, it includes also commercial properties and land. Are you renting just a piece of land to maybe the city or to someone? Then we also have to report that type of rental income on Schedule E, page 1. And then we talk about self rentals. Now, self rentals, I do want to bring this up because I hear this a lot on social media. Would just rent your commercial building or your home to your business. Well, let's talk about self rentals because that's a loophole that the IRS did come in and close because that's what was happening. Clients or taxpayer business owners were renting a personally owned commercial building or even a home to their self, basically, to their own business. So they were able to control how much rent would be charged. One entity, the business entity, was able to take that business expense, right? It's a rent expense. And on the other side, it gets picked up as rent income. Well, this is what the IRS considers self rental because you technically own both sides of the equation, right? You, the landlord, and the lessee, the one that's at the tenant, you're both people, even though you're structured as a business unit or maybe not a business unit. But just know that self rentals do get treated differently. When we talk about real property, we said anything that is permanently attached to the land. And here we have just some examples that are listed, which we went over. But when would you have a client that comes into your office and says that they have a rental property? Well, first, let's ask the ownership, right? Who owns this rental property? We want to make sure that it's under the deed is made out to them personally, or is it made out to an LLC? Because we're going to talk about LLC ownership. Then we need to know the type. Is it a single family? Is it a duplex? Is it multifamily? What type of rental property are we talking about? Or is it maybe storage units that this client does own, maybe a building that uses as storage units? The rental use, we need to know how many days has it been rented. And the very key important information here is, was it rented at fair market value? Now, this is a question that we're asking our clients. And if you have the type of clients that I usually come across is, how do they determine fair market value? Some clients are pretty good that they might go through like a Zillow comparison or maybe a realtor that helped them figure out what the rental value of this property should be. And some of them are probably renting them out to a family member at way below fair market value. And that's where we're going to have to come into more calculations on how we're going to compute that income and what expenses are allowed. And is any of that difference between fair market value and the actual rental value that they're charging? What happens to that gap? Is that going to be taxable income? And so that's one of the areas that we're going to deep dive into our Schedule E series. But just know this is a great overview of what we're asking our clients when we get them for the first time, or even if you've had a client that has had a rental, have you asked these questions? The days that are available for rent. Because when we do our deep dive, we're going to learn that if a house is vacant, can we still depreciate it? Because the rule says that only if it has been placed in service. Well, when it comes to a vacant property, have we listed it on the market? Is there a sign outside the door? And we just have been very unlucky and there's no tenant that has been coming across to rent the house. Can you still take those expenses of running the utilities, of the depreciation while it's vacant? Right? It all depends on available for rent. There's a difference between available for rent and us just having it vacant and still doing maintenance and just repairs to the property, getting it ready to rent. It's not available for rent yet. So at that point is where we need to start considering the difference between the two. And this is more common than not with clients, usually during the year of COVID, where a lot of the great real estate market deals were coming through. They were just purchasing homes that they intended to rent, but it took them a while to fix them up. And so, how do we treat those on Schedule E with the expenses and with the depreciation? Of course, we need to look at the rental income that they did receive, any rental expenses, and basis for depreciation. I've shared with the classes before that I have inherited new clients that have rentals. And I unfortunately am missing a depreciation expense line. The prior preparer did not depreciate that property. And so we have to file a 3115, which we have a great class on it that is available as a recorded session in the Circle community about the 3115, because we need to make up for that depreciation. The IRS says, the law says that depreciation is allowed or allowable. It doesn't matter if you forgot to take it or not. They're going to take it for you on their side when you sell that property. And that's when we step into depreciation recapture. So please start asking for the basis of that property. And we are going to look into deep diving into how to compute the basis when we're getting ready to rent a property. And then, of course, we got to ask that taxpayer, are you active in this rental? Are you the one who made the decision of which tenant can be available to rent your property? Are you the one listing the property, or did you work with a realtor that helped you? How active are you in this rental? Because it matters with passive activity losses and passive activity classification. Now, when we talk about ownership, let's talk about LLC ownership, because you probably have heard the whole hype of LLCs. And so clients are thinking, I need to have an LLC to be able to write off all of these expenses. So if you do have a client that comes to you and says, I have a rental property, but I have an LLC. The LLC is the one that where I run my operations. The tenant deposits the checks into my LLC bank account. My LLC is the rental property. Well, first, let's ask and for a copy of the deed, or ask them the question, well, the name of the title or the title deed of this property, who is it made out to? Because most of the time, I will tell you about 80% of the time, the deed is made out to the client personally and not the LLC. In my experience, banks, mortgages are very hard on having to convince them to be able to allow us to move the deed from our name personally over to the LLC. I've had this conversation with several clients. There was even one client that was going through a divorce, and she was very worried about her rental, how she had to give half of the rental over to the spouse. And I said, first, I'm not an attorney, talk to an attorney, but I do notice that your rental property is not under the LLC's name. So know that you do own it personally. Now, if it comes to community property law and, laws regarding split of assets, that's an attorney question. But again, if you know that the LLC is not the owner, is not listed on the deed of that rental property, then we need to make sure that those are separated. The LLC really has no assets that it owns. This rental property is owned by this person individually. Now, the LLC, limited liability company, the only purpose for that is protection of your assets. Doesn't have to do anything with your ability to take expenses on a business or on a rental. It's more if a tenant slips and they want to sue you, can they come after your personal home can they come after your personal checking account, savings account? The LLC provides that protection, but we know with the LLC comes a lot of responsibilities that we have to maintain, including separation of income. You can't commingle funds, but really let's dive more into the LLC. Don't go just by what the client is thinking that the LLC is the one that's owning the property, especially if the bank account is the one that's receiving all of that rental income. The deed is what matters. So the key takeaway, depositing rent into an LLC bank account does not necessarily mean that the LLC owns the rental property. Now, why does this matter? Because when an individual owns a property, it gets reported on Schedule E. If husband and wife are the ones on the deed of this rental property, then it goes on Schedule E. Now, if the LLC is the one who now legally owns that property, now we're going to have to ask another question. Okay, we know that the LLC owns the property. Now, that LLC, who owns that LLC? Is it just you, taxpayer, personally? Are you the only one listed on those governing documents as the one in the articles of incorporation? Or is it you and your spouse? Or is it you and a brother in law? Who owns that LLC? Because that's going to matter on how that reporting of the rental income and expenses gets adjusted. Does it go on Schedule E? Only if if that LLC is owned by the taxpayer, or if it's owned by taxpayer and the spouse and they are in a community property state. If they're not in a community property state, then we technically have a partnership return, even though it's husband and wife, one person. But if that LLC is owned by two people or more, it's a multi-member LLC. And if you're not a community property state, like I said, it's a 1065 partnership return. Now, if that deed is made out to this LLC, right? And the LLC owner is an actual corporation or the S corporation, if you've been with me during all my S corporation classes, you know that you never want to have real estate in a corporation or an S corporation. It's just the worst thing you can do because you trap a gain in there and it causes a huge taxable event for the taxpayer towards the end when they want to close down their operations or remove that rental out of the corporation or out of the S corporation. So if you do have a client come across, make sure you tell them you should not be doing this. I highly advise for you to take it out. But if you do have a rental property that's in one of these LLCs that is owned by the corporation or they've elected to be taxed as an S corporation, then it gets reported on those tax returns, not on your Schedule E Form 1040. Now, qualified joint venture. This is where you have husband and wife working a business together, whether it be a rental income business or a Schedule C business. A qualified joint venture just means that they are both materially participating and each of them should get credit for that income and that expense. When we talk about a Schedule C, it's subject to what? Self-employment tax. So if you have a qualified joint venture, both husband and wife working this business, they each are going to get credit for their self-employment tax to their own social security number, right? Or their ITIN. Now, if you have a rental, you can also have a qualified joint venture where you actually have this ownership of this rental property owned by husband and wife. Now, if this rental is now owned by an LLC, even though that LLC is owned by husband and wife, that's where we run into more issues. And it's not a qualified joint venture unless you are in a community property state. Now, with that, let's go over to polling question number 1. We have an example here. Remember, for polling questions, just as long as you answer something, you get credit. If you don't see the polling question window, make sure that you send us a chat and just give us an answer, A, B, or C. So a taxpayer, they rent their work equipment to a friend. The total rental income for the year was $35,000. The taxpayer is serious about this type of rental of equipment. He likes the money or she likes the money. And they advertise this work equipment on available for rent sites because they're like, this is a legit business. I like this kind of deal where I can rent my equipment to other people. So where does this rental income get reported? Does it get reported on Schedule C, on Schedule E, or Schedule 1? Now I'm going to give you just a couple more seconds, maybe about 10 seconds to answer that polling question. So what is the correct answer? Let's review the facts again, right? This taxpayer rents his work equipment to a friend. Does it get reported on Schedule E? Let's just recall what Schedule E states. If I go over to Schedule E, at the very top of Schedule E, it says you report your income and losses for rental real estate. So equipment is not real estate, right? This is just a standalone tangible property. Now, when we talk about personal property, because that's what equipment is, personal property, even though you use it for your business, it's still considered personal property. And that's the classification that it receives under the tax law. So when we talk about personal property, it's just movable, tangible property that is not land or that is not permanently attached to the land. When we talk about rentals, so you can see here some examples. You're renting your RV, which I think I've told several of you our experience when we had a travel trailer. We rented it out through a website, forgot the website, rvshare.com. We rented out the RV. If we're not using it, we rented it out and then we used it personally. So yes, this is personal property. Any type of personal property like trailers, tools, equipment, boats, furniture, party supplies. I have a client who has a business where they actually do this. They rent out chairs and tables for these big events or small events, but they have those kind of party supplies that they're renting out, machinery. All of that rental does not get reported on Schedule E because we just saw it's only for the rental income of real estate on Schedule E, Part 1. Now, if you do rent the personal property, well, now we have to first ask, you rented this personal property, how serious were you about it? We see that if the rental of this was conducted as a trade or business, then you report this income and the expenses related to this income on Schedule C. Now, when we talk about is it related to a trade or business, during our Schedule C series, the foundation course that we did, the very first session, which is available for general access, and we have a QR code here, you can go watch the replay. We went through the 9-factor test that the IRS goes through to try to classify your business income as a hobby. Now, we know with the hobby, we don't want to ever have our business be classified as a hobby because that means you can't deduct any of your expenses. You have to report and pay tax 100% on all of the income, but no expenses are allowed if it's considered a hobby. So, in the example for the polling question, I did say how this taxpayer was so serious about this business of renting equipment. They even advertised it on several websites. That's a trade or business, right? It's not just something casual that when somebody comes to him asking for this equipment, is he going to rent it? It's a serious trade or business. Schedule C, subject to self-employment tax. Now, Schedule 1 if this taxpayer was not that serious. They rented it one time, maybe two times, really wasn't active in renting the work equipment. It was just in the garage, and whoever wanted to rent it could casually come, and he charged them a few dollars, a few $100s to rent that equipment. Not very serious about it. There, you can report it on Schedule 1, line 8L, the income and then the expenses related to that equipment go on 24B, and it's not subject to self-employment tax, right? So we do have to tell the difference between first, make sure it's not a hobby. Number two, is it a trade or business? And then personal property rental goes on Schedule 1 on these two lines where you can do the income minus the expenses and not subject to self-employment tax. So make sure that we're documenting our facts with our client. Let's talk about vacation homes. Vacation homes, that lake house, that summer house that some clients have, they might start off as just personal use, right? They close the doors, they don't let anybody stay over, or maybe friends or family members borrow it once in a while, but they're not really renting it for any kind of money. Now, if they do start collecting income, rental income on that vacation home or that second home, we call vacation home doesn't mean that it needs to be in an exotic place. It can just be a second home that you own. If you are starting to collect rents from it, but if you rent it for the greater of 14 days or 10% of the days rented at fair market value, that is what's considered now you are renting it for vacation purposes. So the rule is the 14-day rule. And we learned this about what we call the Augusta rule. And here we have another QR code for the session that we talked about, the Augusta rule, right? Because we know that if you are renting it for 14 days or less during the year, that rental income is not taxable. That's a nice benefit right there. The rental expenses, though, you can't deduct any of those expenses. But hey, I'll take it any day to have that rental income not being available for tax or not subject to tax. So make sure that the 14-day rule is met if we're treating that rental income as not taxable. And of course, your mortgage interest and property taxes, they're still taxable as a second property. And we learned that with our Schedule A series on how we allocate that over to Schedule A. So the minimal rental use receives a special treatment and what many call a loophole of being able to receive income. And we learned the general rule is that we are taxed on our worldwide income, except if there is a tax rule, tax law section that allows an exception. And this is one of the exceptions, the Augusta rule. It's what it's better known for. But this vacation home or this second home that you're renting, if you are renting it for 14 days or more, and you also have personal use, right? So if you're not using it, if you're not renting it out and you're using it personally, then in that place, yes, Schedule E has to get reported, this rental income and the expenses. From our clients, what do we need? We need to know the allocation. Hopefully, they're keeping track of the days that it was rented at fair market value versus how many days that they use it personally versus the days that it was just vacant, but it was available and blocked out from personal use because they were trying to get a tenant. We need to know that breakdown. And sometimes we have clients that come to us during April with this kind of scenario. This is a revenue opportunity for you. Please do not try to give out your work for free. This is where we say, well, for an extra service fee, I can help you determine the exact layout of your days rented. We can sit together, work through your schedule, and look at your calendar for the appointments on when this house was rented to others versus you using it personally. Because we need to look at the allocation. So we're not going to take 100% of the expenses of that home. We have to allocate that between personal use and, of course, the use when it was rented or available for rent. We do have to separate direct expenses, right? So if we did have a tenant at that vacation home and maybe they accidentally broke some glass, we need to replace that glass. That's a direct expense. Maybe we have the maintenance, the cleaning happening after the tenant moves out, or that, there's vacation rental, they move out. We need to clean it for that. That's a direct expense. Allocate the shared expenses. This is when we talk about the shared expenses of utilities, right? Insurance. You're still paying utilities for the entire year, the insurance for the entire year. We need to allocate that between the days that was rented versus over the rental days plus the personal use days. And you actually have to go through computations. And so it's a whole spreadsheet. I have a whole spreadsheet that I help my clients with. But really, again, this is an additional add on service for you if your client doesn't have this already available, which most of the clients will not know that they have to separate direct expenses versus those that are not direct and can be shared and allocated among rental use versus personal use. Because what do we know about personal use? Anything apportioned, allocated over to personal use, the utility bills. If you used it 50% for personal versus 50% rental, that 50% personal, there's no deduction. There's no deduction at all. The only special rule that comes is mortgage interest and property taxes. We actually are able to deduct the personal use of that on Schedule A. Of course, if we're itemizing and we're not taking the standard deduction, then at least this is the only caveat that they will allow us to take a personal use of these expenses and be able to deduct them for tax purposes. Now, with that, let's go over to polling question number 2. We have Mary. She rents a furnished condo as an Airbnb, and guests typically stay there 3 to 5 nights. Where should Mary report the rental income and expenses of this Airbnb? We already talked about the rules of Schedule E, right? It reports the rental income or loss from rental real estate. And here we're saying it's a home, a condo that we're listing on Airbnb. So far, it seems okay, like Schedule E. Now, when we talk about short term rentals, where do we report these? Is it still Schedule E or is it Schedule C? Or my favorite answer that you need to give all of your taxpayer clients that call you for a quick question is it depends. It depends. I need more information. Let's schedule an advisory consultation for this. Please don't give your advice out for free to your clients unless you have them on an advisory plan or that you are providing them a service separately as a consultation. Now, the correct answer for this is my favorite C. It depends. Because, yes, a rental property that is used as a short term rental on Airbnb, vacation VRBO, or just you're renting it for short term periods, you can actually have to list it on Schedule C instead of Schedule E. But that's where we're going to go into the differentiation because it's not always the case. It depends. And so when does it have to go on Schedule E versus Schedule C? I would like to introduce to you substantial services. Substantial services means that you are providing services that go beyond the rental of your property to your guest, to your tenants. Now, what we consider not substantial services is your regular cleaning that has to happen when they vacate your property. The heat, the utilities that you're providing, the pots and pans that have to be there for them to enjoy, cooking in your condo or in that Airbnb rental that you have. Repairs, maintenance, these are not considered substantial services. So therefore, this gets reported on Schedule E. What about if we are providing substantial services? We're doing daily housekeeping. We are providing them additional services as a courtesy of maybe taking them out on tour guides and showing them around the city. We are providing them breakfast. then we are really operating more as a hotel and not a regular short-term rental on Schedule E. We are providing substantial services. So if you do have clients that do have short-term rentals or any type of rentals, we need to just make sure that they truly are just landlords, kind of hands off and maintain the property as needed, and not really getting to know these tenants and providing extra services to them like a hotel, because that is subject to self-employment tax on Schedule C. Now, on Schedule E, another thing that we do report is royalty income. The most popular type of royalty income is what you get income received for allowing somebody else to use the property rights to something. Most common is those authors that publish the books, right? Or those, if you can see like the royalties, if you created a song and your song gets played and you're receiving royalties for that, those type of royalties get reported on Schedule E. And you have oil and gas and mineral interest too. Maybe you have land that you are receiving those rights. You kept the rights of the oil and gas. Not sure about where you are located in the US, but I will tell you here in Texas, when you purchase a home, you always have the disclosure that you do not own the oil and gas mineral rights of your own home that you're buying. I don't know if everybody else goes through that in the States, but that's at least in our area here in the state of Texas, in the city specifically of Dallas, we've been having that disclosure, I think, I'm going to say about 40 years now, where you no longer can own any type of the mineral rights that come with your property. Now, when we talk about page 2 of the income or losses reported on page 2 of Schedule E, this is where we report the Schedule K1 income. First, let's talk about part 2. At the very top of page 2 of Schedule E, we are reporting the Schedule K1 that gets reported to our taxpayer from a partnership or an S corporation. We know the basic rule about partnership and S corporations, they're flow through entities, meaning that they report all of the income and expenses at their level, but they don't pay any tax. Instead, they give each owner of that partnership or of that S corporation a Schedule K1 for that partner's or shareholder's ownership percentage allocated to them from that income and those expenses, the credits that are generated up at the level of those entities. So all of those items that you see on Schedule K1, not all of them will flow over to Schedule E, page 2. We really have to pay attention to each box line item. For example, ordinary business income, box 1 of both Schedule K1s of partnership and S Corps, yes, gets reported on Schedule E. Even rental real estate, Schedule E, part 2. But the interest, the dividends, the capital gains, they all go to different forms on our 1040 or our schedules on our 1040. Now, if you see here the schedules that are listed, Schedule B, Schedule D, the Form 4797, but just know the most, what we are really paying attention to for Schedule E, page 2, is the ordinary income or loss, or even a rental if that partnership owns rental property. Now, when we go further down on Schedule E, we have part 3 on page 2. That reports the income or loss from estates or trusts. So first, let's talk about estates or trusts, right? We know that when these estates or trusts are passing down, also flow through entities, are passing down or distributing down any of their interest or dividends or anything that you're listing here, business income, that gets reported on Schedule E, page 2, on part 2. Of course, or page part 3. Now, when you receive a Schedule K1 1041, those will probably be coming from your trust or your estate if it gets reported on a 1041. Now, what is an estate? Because when I started my career in public accounting, to me, I'm like, estate, trust, isn't that the same thing? And I'm still trying to understand, because I grew up in a family that we didn't talk about estates or having estate tax or trust, right? This is not something that nobody openly talks about. But I will tell you, an estate, just general, high overview of what an estate is. When a person owns assets, an asset is a checking account, it's a savings account, maybe a rental property or their own personal home. When a person owns these assets and they pass away, all of the income, because you can generate interest income on your bank accounts. You have maybe a business or you have a rental property, they're generating income. All of that gets reported on an estate return. And we have to prepare, or the trustee or somebody, whoever precedes us has to prepare an estate return. Because what happens when we pass away, all of our assets get bunched up together, the value of our assets. And do we own more than $15 million worth of assets? If so, we have to file an estate return and we have to pay an estate tax, which is one of the highest at 40%. But really, it's one of those just giving you a very high overview that if we don't even meet that limitation or that threshold of 15 million, we're not going to file an estate return. Now, when we have a trust, the difference between the estate and the trust, right? Usually I'll go back and just say the estate, the income that's received before the date of death gets reported on a 1040 return. Any kind of income that those checking accounts are generating or those businesses are generating after the date of death, that gets reported on the estate return. For a trust is actually created. And you can create this as you're living. Because what happens, especially here in Texas, if you pass away without a will, or even if you have a will, you have to go through probate court, where you have to basically prove the validity of this will. Or if you don't have a will, or you're, the beneficiaries or the ones that are receiving your inherited property don't have a will, they still have to go to court. One, to prove the will, or two, to say, I don't have a will, but I am the rightful decedent of this individual that passed away. They're my mother, they're my father. So I am rightfully owner of all of their assets. With a trust, though, you get to skip probate court. You create the trust today and you say, hey, all of my property, my bank accounts, everything is going to be put into this trust. And this trust just lays dormant. Nobody really does anything with the trust. There's no trust return. The day that that taxpayer passes away, the trust wakes up and says, okay, hey, listen, I'm replacing this taxpayer that passed away. I am the owner of this property. And if I look at my trust documents, this property is supposed to go to this child versus this bank account goes to this other child. So you get to dictate, even when you're gone, who gets what. So these individuals that have the trust and have assets in the trust, well, you pass away, the business is still running. The rental property is still producing rental income. Your savings account is still producing income. Any type of income that gets distributed down to your beneficiaries, whoever you stated is your heir that you want them to receive these benefits, they're going to receive a Schedule K1. And that's what gets reported on Schedule E, page 2. Now, I'm going to go really quickly over the REMIC, which is, again, not very common. It's income or loss from a real estate mortgage. That's the bottom part of Schedule E, page 2. And really what this is if your client receives this every quarter, a Schedule Q from Form 1066. And this is because your client either got talked into or they thought it was a great investment idea to buy an interest in this investment where they pool together either loans, either mortgages or types of loans that are coming together, and they receive an interest payment, either a residual or interest payment every quarter. And this gets reported on Schedule K. If you do have this type of client, just know that it gets reported on Schedule E, page 2, towards the bottom. Now, before we end the session, I am going to give you a quick preview about passive activities, because the general rule is that all rental income from rental real estate, general rule is that it is passive income. Now, what does that mean and what are the limitations? That's what I get so excited about deep diving into it next week, because we are going to break this out into 2 sessions. One, we're really just going to dive into what is passive activity, what are the different kind of rules that come with a rental, like the active participation, allowing a $25,000 of a rental loss against W-2 income, material participation tests that have to be met if we're treating these losses to be able to be deducted with non-passive income, and then, of course, real estate professional status. Again, these come a lot during social media that just make it sound so easy, which is not, I will tell you right now. That's why we're dedicating 2 separate sessions to just talk about these different type of tests that need to be met. Now with that, let me go with the last polling question. Remember, this is 3 polling questions throughout. This is your last one. Will you be joining us next week as we break down more Schedule E and dive into the different types of rentals and passive activity and material participation? Because I'm really excited about that. So hopefully I get to see you next week, a week from today. And we're going to divide it again in 2 sessions. And then we are going to end it more with like active participation and at-risk rules, because we have different rules and tests that we have to pass in order for our loss on a rental to be able, or even on a Schedule K1, to be able to be deducted against any other type of income on our 1040. Now with that, I will let you hear, before I open it up for Q&A, scan this QR code, complete the survey. It's not mandatory, but it is highly appreciated. If you give us your feedback, what other sessions would you like to learn about? What other series? I'm excited to even go into like Schedule 1 or Schedule 2 series, even the 4797 when you sell an asset, or even just the depreciation form 4562. That's how we shape our sessions in the community by popular demand. Whoever can submit any feedback, we take it all together, and then we structure our curriculum as we go through the year. Let's see what else I have on this slide after. Is just to join our Pro Circle membership. Now you can join as general access, which is the session that was available for today. We are providing CE. That's why we have it on Zoom. Most of our sessions are provided, if we don't do CE credit, we do provide them inside of the Circle community, especially that one that's coming up soon about dropping your @gmail.com. You don't want to miss that one if you are still using @gmail.com. It's not as hard as you think about getting your domain to switch over to a more professional kind of email that you can share with your clients. Okay, so Q&A. It looks like we do have some questions. So let's go with our very first question. It says, if your child is living and paying mortgage, would it be considered a rental under the parent's name? Yes, so this is the thing. If we are, right, the general rule says what? If you are renting real estate, you need to have the income and expenses that have to be reported on Schedule E. If you are charging your child a rent, then we have to technically, if we're looking at the law, we have to see, well, that room that you're renting, what is the fair market value? What do other homes? The parent is the one that owns the home, not the child. Now let's ask this. I'm assuming the child is not a dependent, right? Because if they are a dependent, it's because we're providing more than 50% of their financial need, which includes the house, the roof over their head. So let's assume it's not, they no longer qualify as a dependent and they're just renting a room from us. Then yes, we do have to report that as rental income. We're going to have to take depreciation, even if we don't like it because of depreciation recapture. But again, you don't want to miss out on depreciation. Again, the one thing is, are we renting at fair market value? Because we have to make sure that if the rental, the fair market value of that room is $1,000 and we are charging $800, we still have to claim $1,000 as fair market value. Even if it's the parent, it could be the child renting from us, it could be a cousin or just a friend. We have to go into the allocation of the expenses, like we talked about for those properties that are personal use. We're using personal use. We have mixed use, right? Personal use of our own home and also rental income now. The whole utilities of the home. We have to allocate the square footage. When was this room rented? We have to allocate the insurance, the home insurance. Are there any expenses directly related to that one room? The paint in the room, the maintenance in that room that we can trace as a direct expense. We don't have to allocate that portion. Now, I will tell you that majority of my clients come to me with this, and I tell them, unfortunately, I can't in writing advise you, don't report it. How would the IRS find out? No, we can get in trouble. I will tell them, I always tell my clients, if it was my return, and since you already disclosed it to me, I cannot sign off on a return if we're not reporting that income and that expenses. I would not try to risk it and not report that, or have it under the table, because they've already told me, and now I can't unhear or unsee that stuff, right? And most of the time, I will tell you, and I've shared this across, is when I represent clients during an IRS audit, and another preparer is the one that prepared that return that was under audit now, the taxpayers will throw us under the bus as soon as they can. It's one of those that they try to blame everybody but themselves. They always try to say, well, the preparer never advised me, or I told my preparer I was renting this room and they told me I didn't have to report it. That is the number one thing that they say. Well, they said I didn't have to. And that's the key that the auditor is listening to, because the next step after we're done with my client's audit is they go over to that preparer and open it up for investigation. You don't want to ever get into trouble for a client over some kind of fraudulent investigation, because then they open up your entire client list. So yes, word of advice, we always want to make sure that we're following our due diligence. So we have a property that was rented with Airbnb for the summer only. Should it be reported in Schedule E? Yes, the first thing for this is I would ask, are we providing substantial services or just regular services, right? We're only providing the regular cleaning when they leave, and when they, we don't provide any daily cleaning, daily changing of the sheets. We're not providing any kind of breakfast, and we're not treating it like a hotel. So even if it's for the summer, yes, for that summer portion, we have to start declaring the income and the expenses. Now, for the rest of the year, we need to ask the question, was it available for rent, or did you just completely take it off the market? Because if you took it off the market, then we have to pause on all of the expenses. We can't take any utility expenses. We can't take any depreciation expenses. Everything has to stop the moment we remove that rental off of the market. It's no longer available for rent. And so we need to make sure to take that into consideration of, do you really want to take it off the market? I always tell my clients, why are we taking it off the market? Is it just for personal preference? Maybe you're using it personally, or maybe you just don't like to deal with renters during the winter months, because maybe it's a vacation home or an Airbnb on the beach where there is no longer good weather during the month of January. Still keep it on the market. No worries, still keep it, because we can still take the expenses. They don't have to pause. And even though money is coming out of our pocket to maintain the utilities, we won't be able to take a deduction for utilities, because the key is it is not available for rent. What if the rental home is under a living trust, but the taxpayer is part of the living trust? Yes, these are most likely, Patricia, what we're asking is, what type of trust is it? It goes into different types of trust. The most common trust is the irrevocable or the revocable trust. It's a living trust that basically, and I will tell you my personal experience, we have a trust where our home, the deed of our home is made out to the trust. Our bank accounts are made out to the trust. Everything is made out to the trust, but we don't, even the rental homes, we own the rental home. All the deeds are made out to the trust. We don't have to report any type of trust return. It's just really there holding that protection. And we created the trust because of our kids. We went to a seminar and we learned about all the bad things that can happen if you pass away with a will, or even worse, without a will. And here in Texas, I'm telling you about the whole probate court, that it can take about 9 months, and you still have to pay an attorney to defend your will and prove your will. We said, let's see, we got convinced very easily. And I see the benefit. So having it in a trust, yes, you can have a rental home inside a trust, still reported as usual. The trust does not really matter until you pass, but do make sure that you understand what kind of trust it is, because there could be irrevocable trust, living trust. It could be the grantor trusts are the most common, and like a CRET is another type of trust. There's all different kinds of trust. So I'd be curious, Patricia, if you know what kind of trust your client has. What factors determine whether an Airbnb rental activity belongs on Schedule C or Schedule E? Nancy, the most common is the substantial services. And so ask the client, what kind of services do you provide your tenants? And we saw some examples of what the IRS considers substantial services is daily upkeep. Just think about a hotel. When you stay at a hotel, they're going to change your sheets every day, unless you put, of course, your do not disturb sign outside. But that's what they do. They're going to change your sheets. They probably provide a complimentary breakfast. You can step downstairs to the concierge to ask about restaurant recommendations. That is substantial services. That gets reported on a Schedule C. Most of the Airbnbs that I know are always going to be on Schedule E, because they only upkeep it once the tenant checks out. They send the cleaning crew, they clean it up, get it ready for the next tenant, and that's it. They don't provide breakfasts. They don't provide daily cleaning. And so that's where we step into, okay, yeah, they provide pots and pans and maybe the free coffee, right? The coffee filters, the coffee there, but that is not substantial services. Substantial services, hotel living. Just think about that. Where is the property taxes, the interest, and the insurance reported if the money acquired to add an ADU, so it's an addition, right? In addition to the main residence, come from a HELOC. The ADU is rented out. Oh, okay, okay. So we have a personal property residence, right? And then we have an addition built out. And that addition, we got a loan, right? And we're paying interest and we're going to pay property taxes on our entire home. And most likely the county is going to notice that we added an addition and they're going to add value to our assessed value of the property, charges more property tax. At least here, that's how it is here in Texas. And so what we're asking is, where is this reported and the insurance? So if we are renting it out, it's a step. Is it a separate unit or is it together? Now it doesn't matter, right? We consider it as part of our whole residence. So let's say our square footage was 1,000 and now it's 1,500, and that addition is 500. So we are going to do the allocation. What are there any expenses that we are sharing with that addition? For example, utilities, or does that addition have its own meter that's tracks its own electric bill? Do they have their own electric bill? What about the plumbing? Do they have their own drainage system, or is this all part of our city water bill? So if we are sharing expenses, we're going to have to allocate, right? The 1,000 square feet is personal use. 500 is what we're renting out. Start thinking about any of those expenses that are related. Now, property taxes and interest. Insurance, again, insurance, is it insurance just for that unit, for that addition, or is it insurance for the entire? If it's for the entire home, including the addition, then we have to allocate the percentage. For property taxes and interest, the same thing, allocate that, whatever gets allocated on Schedule E for that square footage versus Schedule A for our itemized deductions. And the main resident come from, oh, okay, so the HELOC. So HELOC, it's a line of credit, right? That we go to our mortgage, our banker, and say, hey, our house is valued at $1 million, but I only owe on the mortgage, let's say 600,000. I have equity of 400,000, and so sometimes these banks will let you borrow money against your equity as a line of credit. Like, okay, you're right. We're going to give you $200,000 of an available capital that withdraw from it as you please to pay for what you want, right? Because we have your home as collateral. This is the thing. If we're using those funds for vacations or personal spending, we can't deduct that type of interest on Schedule A. Now, if we're using it for this home, that's where we do the allocation of Schedule E versus Schedule A. Just make sure that we're not using it for personal. If we are, just don't deduct that on Schedule A. Can you please explain again what happens when a couple owns the property in Texas? Yeah, so in Texas, if this rental property, first let's ask the question, the deed, right? Because sometimes the client thinks, well, it's my property, but they probably forgot that they put it into an LLC. Who owns the deed? Who on the deed records, the property, the assessor, what do we see on the title? Who owns the deed? Is it really a husband? Is it just the husband, or is it husband and wife? We know here in Texas, we're a community property state, just like California. So what my husband owns is mine and what I own is his, right? We're considered one person. So if both of you are in the deed, or even if one, right? As long as we're married and there's no prenup or there's no kind of postnup or anything, really technically they're both owners, even if it's just one of them listed on the deed. So when they both own the property, we can consider it a qualified joint venture when it comes to Schedule E for rental purposes. On Schedule E, towards the top, you'll see a checkbox that says that has the acronym QJV, which is qualified joint venture, and that's where we're going to list the rental property in two separate lines. We can call it 123 Main Street taxpayer, 123 Main Street spouse, and we're going to divide all of the income and all of the expenses by two. Now, I am trying to figure out, why would that be a benefit on Schedule E? I can understand the qualified joint venture for Schedule C because we want to give both the taxpayer and the spouse credit on their Social Security benefits, right? They're paying self-employment tax. But for a Schedule E, for us to divide that in half, I don't really see much of a benefit unless there's some kind of I do tell it to my client, right? I don't see a tax benefit. Now, maybe for legal benefits, you do want to separate on your side, maybe talk to an attorney if you want those income and expenses separated there. But I think we're just asking, I'm saying, can you please explain again what happens when a couple owns the property? And so, yes, if they own the property together and they're in Texas, disregarded entity, Schedule E. That's a rental property. If they own that rental property and their husband and wife and they're not in a community property state, the same thing. It's a Schedule E. However, if they do put that rental property, the deed gets changed to the LLC, and they're not in a community property state, then they have a partnership return. Us here in Texas, the LLC is the same thing. It's disregarded. If it's owned by husband and wife, it's still the same person. Schedule E. Doesn't matter if you have an LLC already for that. What if the addition was added to a rental home? How would the allocation be made? Oh, yeah. So if we have an addition to a rental home, are we renting the addition to that rental home? Then it would just, we need to add that addition, the cost basis of that addition to the depreciation schedule and start depreciating it the day that we started renting out, right? Because that's the rule. When you place it into rental use, that is when the depreciation starts. While we're constructing it and getting it ready, we can't depreciate it yet until it's finally used. But the same thing, if we have this addition to a rental home and we have another tenant in that addition, it would just be the separation to keep the books clean, right? Because we want to know how much income and expenses are generated for this part of the rental versus that part of the rental. But it would be the same thing allocating with the interest and the insurance. If the insurance covers the entire home, then let's just divide it to keep our books clean and know exactly what our rental profit is on the addition versus the tenants that are in the rest of the home. And will this be recorded? Yes, we are recording the Zoom meeting and we'll share it with you. It takes about maybe about 2 to 3 hours for the Zoom to process the recording. And we are going to post it on the Circle community and send everybody a notification when it's available. Okay. If we don't have any other questions, thank you again so much for joining me. Your CE credit, if you met the requirements, should be sent out within 24 to 48 hours. If there's anything that comes across your mind that can help me build my Schedule E series going forward, please send me a message. I love to create content for my curriculum based on what we have questions on. So thank you again for hanging out with me today and hope to see you next week for our Schedule E deep dive series. Take care, everyone.